Welcome to the 3Edge Week in Review for the week of January 23rd, 2023. I'm Fritz Folts, the Chief Investment Strategist here at 3Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3Edge Asset Management. Today, Steve and I will be discussing echo bubbles, which is the idea that market bubbles don't necessarily burst all at once, and that market declines from bubble territory can be punctuated by rebounds, otherwise known as echo bubbles. Before we get into that, a quick look at the global capital markets. And equity markets have had a pretty strong start to the year. Just recently, for the second time in 2023, the S&P 500 broke above its 200-day moving average. And on Friday, investors received good news on the inflation front, as the Fed's preferred measure of inflation, the Personal Consumption Expenditure Price Index, which is a mouthful, eased in the month of December to its slowest pace in over a year. And consumer spending also fell. The PCE, which excludes food and energy, rose by 4.4%, which is, it's obviously well above the target rate, right, of the Fed for 2%, but it was the slowest pace of growth for this index since late in 2021. And thus far this year, ex-U.S. equities have done even better year to date than the U.S. markets. European equities up almost approximately 12% thus far in 2023. In addition, the increase in the price of gold has basically kept up with the performance of the S&P 500 so far this year. Meanwhile, investors are waiting next week's FOMC meeting and the announcement of the Fed's monetary policy decision. The consensus is the Fed will increase short-term interest rates by 25 basis points. They had me well trained. And the 25 basis points would be a reduction in the magnitude of the Fed's interest rate increases, which, were very aggressive throughout all of last year. So with equity markets off to a solid start, and before investors maybe get too far ahead of themselves, maybe it's a good time to talk about echo bubbles, which speak again to this market psychology and the idea that investors have a hard time giving up on the narratives that caused the initial market bubble. So Steve, let's bring you in here. And to start off, maybe just clarify what we're talking about when we're talking about the potential for echo bubbles.
Well, Fritz, as we studied all the different stock market bubbles over history, we've noticed that there are patterns. And the reason why there are patterns is because human nature keeps repeating similar behavior over and over. And so one of the patterns that we found is that it's very common after a big stock market bubble, and then after the subsequent decline. Mm-hmm. At some point, investors get tired of all the pessimism, they get exhausted by the bear market, and they have nostalgia. They pine for the good old days when it was a lot more fun to be in the stock market bubble. And so when enough of them form a crowd psychology, all of a sudden they start hoping that everything's going to be like it was. And we call that an echo bubble. And it's a hope for a return to the good old days. And throughout history, we've seen this phenomena. And the echo bubble is never or rarely as big as the original bubble, doesn't come up to the level of the original bubble, but it does provide some temporary relief during the bear market.
All right, excellent. So why don't we talk now then about what are the current signs? What are we seeing in the market that could signify that we are actually experiencing an echo bubble currently here in 2023?
Well, last year, the U.S. stock market fell nearly 20%, but actually through the first 9 months of last year, it was even a sharper fall. And since October, the market has been rebounding and it has been showing certain signs of an echo bubble. For instance, very common during the stock market bubble of 2021, we saw this big psychology called buy the dip. People going in every time something fell, buying the dip, and then during the stock market bubble being rewarded because they bought low and then they could sell higher. We had this phrase called FOMO, or fear of missing out, and we're seeing repeat of that in 2023 or even since October of 2022. We're noticing that some of the biggest losers during 2022 are the biggest winners over the last few weeks. There are tech stocks that that really got hurt hard.
Right.
Back in 2022, that are some of the biggest winners now, still way, way below where they were in the peak of 2021, but rebounding strongly. And some of the tech stocks that are doing the best are companies that have no profits, and those are the ones that got hurt the worst. We're seeing Tesla as an example, the stock that got hit very badly in 2022, have a big rebound now. Crypto, Bitcoin and cryptocurrencies that got hit massively during the bear market, rebounding, showing some strong rebound this year. And then even the return of meme stocks. And these are stocks that have no fundamental business going up. They defy gravity. And it's as if they're a group of traders all talking on social media, deciding, okay, we're going to go after this stock where things are bad. There are all these short sellers or hedge funds that have been shorting the stock. Let's go punish them. They all come in. And just a few weeks ago, we saw a company, Bed Bath & Beyond, that was warning that they're getting closer and closer to bankruptcy. And then the meme stock people took over, and it went up 68% in one day. So,
Right.
So we're definitely seeing signs of what we would call an echo bubble.
So now I have a question that, well, it's kind of impossible, but the question is, how long could these echo bubbles last, or how long might they last?
Well, you're right. That's a difficult question, but there's a quote I really like that was said back in the 1930s by a famous economist, Lord Keynes. And some people don't know he was also a very active investor, not just for his own portfolio, but he was asked to invest for major institutions and universities and so on. And what he said was, markets can stay irrational longer than you can stay solvent. And what he meant by that was there are times when crowd psychology and market psychology take over, and you could throw out valuation, you can throw out the fundamentals, and that crowd psychology can drive things for longer than a rational investor might expect, but eventually things will go back to sanity again. And so we have this issue where echo bubble is part of market psychology or crowd psychology. And the length of the bubble depends on events that haven't happened yet. So that's why it's hard to predict how long they will go. For instance, as you mentioned, next Wednesday, on February 1st, the Fed will make an announcement, not just of how much they may raise interest rates again, but guidance as to what they're thinking in the future. And that could either extend the echo bubble or that could kill it right there. Corporate earnings, we're in the middle of corporate earnings seasons. And we have companies that are being compared to expectations. And if this goes better than expected, it could prolong the echo bubble. Worse than expected, we could see we go back in the next phase of the bear market. We have government debt brinksmanship right now between the Democrats and Republicans about what to do with the debt ceiling and how we're in danger of defaulting unless we extend the debt ceiling. And depending on how that plays out, that could extend or kill the echo bubble. The war in Ukraine, the pace of inflation reduction, all of these things haven't happened yet, but could help determine how long this echo bubble lasts.
Great. All right. So, as always, my final question is based on what we've discussed here today about echo bubbles. How should investors think about positioning their portfolios here early in 2023?
Well, precisely because it's hard to predict how long this can last. It can be painful, even for long-term investors, to be completely out of the market and watch the market go higher and higher. And the temptation is to hang in there, and then to feel so much pain, you throw all your investments in right at the peak before the echo bubble dies. So you don't want to follow that as an investment strategy. On the other hand, to be fully invested right now during an echo bubble is very dangerous because the echo bubble can dive at any time. So we think the overall strategy is to stay cautious overall. Don't invest all of your dry powder at this time into the risk assets, but distinguish between overvalued assets and undervalued assets. With overvalued assets, like the U.S. stock market, which we deemed back in 2021 reached excessively overvalued territory, historically overvalued, despite the 20% drawdown in 2022. it's still, by our measure, highly overvalued. So we would be very cautious about adding much to U.S. stocks. On the other hand, late last year and early this year, we found that certain emerging market equity indices were so undervalued that more so than any time in history. And so even though there's plenty of bad news in emerging markets, as the dollar peaked and started to come down, that acted as a tailwind. That coupled with the undervaluation encouraged us to start modestly investing in certain emerging market securities. And those have done very well since October, even better than U.S. stocks. Similarly, early this year, we started investing a bit in European stocks. And while there's no shortage of bad news going on in Europe, the fact that inflation is coming down so fast in Europe, the fact that Europe is also relatively undervalued compared to, say, U.S. stocks, we began to tiptoe into European stocks, and those also have done even better than U.S. stocks since the early this year. So we think that there's a balance one can play overall to not have too much in equities, but favor some of the beaten up, undervalued non-U.S. equities, still be cautious about the overvalued U.S. equities. And then as far as hedges go, people noticed last year bonds were a terrible hedge against the equity decline, because in a period where inflation is higher than targets, bonds are vulnerable to losing capital appreciation or actually experiencing capital depreciation as interest rates continue to rise. So rather than that, we found that certain hedges like real assets have been much more effective. And we see gold doing, as you mentioned, doing very, very well over the last several months.
Excellent. Great. So why don't we wrap it up there? And on behalf of Steve and everyone here at 3Edge, I want to thank everybody for listening, and we'll see you again next week.